All right. Hello, everybody. Thank you for joining on. You're all the people that actually show up on time. So congratulations to you. That's wonderful. As most of these calls go, we have a few stragglers that show up a little later. Itai, this is actually very cool that we're getting to talk right now because something nuts happened today. Oil became negative. Literally, last time we were talking about oil was historically cheap, but this took it to a whole nother level today. So we're going to get to talk about some of the crazy things that are happening with oil in addition to our agenda. So for everybody else who isn't there, what we're going to do is we're just going to do a few quick introductions on our end, talk about the agenda, then we're going to roll right into it. Okay, so I'm Jeremy. I'm the co-founder here at Equilibrium Ventures. I've built a number of successful real estate technology companies in the past. The companies I've started generated revenues in excess of $500 million in total lifetime sales. I spend a lot of time on capital markets now with Itai, who's my partner here. He's the host. So Itai, why don't you introduce yourself to everybody really quickly?
Hey guys, I'm Equi. So formerly UBS. Afterwards, I co-founded actually a wealth management firm that eventually reached assets over $100 million. Later launched a much more fun options-based hedge fund that had a pretty good track record, 2x the returns of the S&P over a 4-year period of time with no correlation, basically trading options volatility.
You know, if you would have been running that fund this year, we could have been making some money. So we're gonna have to get you trading again.
Well, that's hopefully going to happen pretty soon.
Yeah, definitely. So everybody, you know, we talked about the agenda today. I love getting to fill you in on all the high level stuff, but really you came to get something. We want to give it to you. So the first is what the heck is happening with oil, and we're going to talk about that. Gold is near an all-time high. All right. But we really got to ask ourselves, like, what is driving the price of gold long term? And it's going to be something that you might not have previously thought of. We had a little bit of a conversation about, you know, Trump says the economy is going to open in early May. There is everything else that other people are saying about when it's going to open. So we're going to talk kind of what the, we're going to talk about, you know, what the experts really think as it relates to that. We're very lucky. He's not on the call right now, but our special guest speaker is Alan Lev. He's the chairman of Belgravia Group, which is one of the largest development companies in Chicago. That's a Chicago flag right there as well. Alan is going to talk to us about the future of real estate. It's actually going to be interesting because he's going to give us a little bit of a history lesson about the migration from cities to suburbs, suburbs back to cities. And we're going to talk about, you know, maybe why some of the periphery areas of a city might become a very interesting investment opportunity in the years to come. Another thing is the last conversation we ended was this speculation about, you know, where is the future of real estate heading, and specifically office real estate. And a lot of people here were pretty bearish on that. So we designed a trade that you can actually run, and it's going to talk about basically if you have a thesis that the markets are heading down for a specific asset class, kind of like office real estate, how you could actually place a trade for yourself. And then of course we'll open it up to Q&A, and the whole point is that this is supposed to be fun. It's Monday, it's the end of the day. We want everybody here to be engaged. I'm here. You can just send a message in the chat. So before I turn it over to Itai, last thing I'm going to ask is for all of you in the chat, why don't you just introduce yourself, where you're from, what you do, and that'll help give context to everybody else. And in the meantime, Itai, why don't you tell us what the heck is happening with oil?
Yeah, it's super interesting stuff. We have seen oil going negative today, I believe, first time in history. And everybody is saying, well, this is pretty nuts. How can that even be? So going to how that actually is possible, because I would say oil has gone negative, but it hasn't gone negative all the way through. And in a lot of ways, it's in the same price it was 2 or 3 weeks ago. So I'll go into a little bit more on that. The second part is when we talked about oil being historically cheap about 2 weeks ago, with the big caveat, it was like, be careful of the falling knife, because nobody really knows how low can anything go. Normally that would have been 0, but today we've broken the barrier on that. So we really don't know how low things can go. So it's good to wait for stability. So going a little bit into what oil has done, there's been a lot of chatter today about a large fund receiving a margin call. Basically, they had this whole thesis of, yes, we think oil is cheap on the front end, and they tried to buy the contract, and they couldn't come up with enough collateral to meet their requirements for delivery tomorrow, and they had some kind of margin call. It's also contributed to some of these leverage ETFs and other ETFs like USO that had to roll over the contract and didn't have enough demand for the next month. So I'll go into the real issue here is the storage facilities. And what that means is that a lot of people don't want to sell the oil right now. They're saying, well, you know what, I want to wait until prices are a little bit higher when they stabilize and things like that. So what they do is that they just rent storage facilities and keep the oil stored at those facilities. Now, the oil facilities are almost completely full. And that creates a situation when the rents for more oil has just exploded on the upside. And it's at the point that the rent to store oil is so expensive that it's almost more beneficial for people to say, you know what, I'll pay you if you can just take the oil from me today. And that's basically what a negative oil price is. So I want to share that with you guys here. I'm going to show you.
Is that very much like a short, like the opposite of a short squeeze, basically, is what we just saw?
I think so. I think it's very similar. So you can see here on the platform, this is all live stuff. This is the price of WTI future. This is the May contract, which is expiring tomorrow. And we can see, a negative bid and a negative offer at the -$8, -7 range. But if we just go 1 month out, the price is still $21. And then the next month, the price is 27, 29, 30, etc. So to go back into how futures are based and how this whole term works, we have to keep in mind that every month has its own price. And that's driven by supply and demand for that period. That's why these futures market help our economy to function, right? We can, an airline company can determine for March 2021 how much they're going to pay for their oil, et cetera, and et cetera. So that's really what is the driver. Yes, we have a negative price, but that negative price is only tomorrow. When that contract expires tomorrow, we're going back to oil being worth $21. That's why oil is negative, but it's only negative for a day. How is that going to last? Well, that's actually a good question. So this is a visual way to kind of look at this stuff. Today or tomorrow's price for oil is negative $14 or $13, whatever it was. It's the delivery. And then the following month is $20, etc. Keeps going higher and higher. This is referred to as contango in future speak. So the issue here, I think, is that we say, well, you know what, if we still think oil is cheap and we can buy this next month is $20, if this issue is not resolved as far as demand not picking up and storage being completely full, who's to say that that future price is not going to collapse to zero or negative come next month's expiration? And that's the biggest issue in the oil market, I think, as of right now. So just wanted to cover that quickly.
And Itai, what are those storage costs looking like right now for a barrel of oil?
So the market's kind of answering that right now because the contango is what factors in the cost of storage. So if the spread is this high, I mean, I would say it's pretty fair to estimate that storage costs could be as high as $20 or $30 per barrel per month. And that is why we're seeing that massive pressure on oil. So, if you could store it for a few months and sell the future month, then you can make free money. But it doesn't really exist that way because the cost of storage is just so expensive.
So doesn't the U.S. government have a bunch of extra inventory where they could potentially store some of this and cover some of those stimulus checks?
I mean, potentially there's the strategic reserve that the U.S. government has. From what I heard today, they have room for 70 million barrels of crude oil potentially. If they were in the private market, they could lease up some storage space and make a few bucks to cover for all the spending they're doing.
Do you have any pricing on what the skew on the options are for this month, next month on the crude oil? I mean, people betting it to go to 50 cents next month on the put options and the skew. You looked at that?
Yeah, I actually do. Let's see here. So we are at WTI, and we can see here at front month. And here is your skew. Here's your volatility skew for front month, and it's based in deltas. So the implied volatility on the $5 put is over 350%. And the skew is heavily to the downside, which factors this this steep contango curve. When I said, well, you know, the front month can go from $20 to zero, it's almost already priced in options.
So what does this mean for the person who doesn't mess around with options?
So this graph, or what we call skew, measures the amount of demand for puts versus calls. Calls basically bets or insurance for the upside. Puts bets or insurance for the downside. So the bets or insurance premium that's paid for the downside is significantly well over the one for the upside, which means that if you owned oil and you were worried about it going to zero again, you would have to pay a very steep premium to insure for that. And it means the risk of the downside is still very extreme.
Let me ask you this, because isn't this just this particular chart just showing the volatility of the $5 put? I mean, do we see the $5 call, the volatility of what that is on there?
Yeah, let's we can just go.
It goes from the 5 put to to 50, and then it starts doing the call. I guess it's on the other side of the chart there.
Yeah, it's just on the other side of the chart. It's
okay,
more flat. This is just the call ratio skew, and this is the.
Jeremy's picture was messing it up, so.
I understand.
Guys, come on.
But I as much as I'd love to go into to option skews and talk about how that's gonna do, I think we can talk about it later if you like.
Hey Itai, can I throw one your way? I bought a call today to buy USO at 50 cents in December 2022. Right?
Okay.
Can you explain how contango can destroy that?
Yes, I'd be happy to. So let's go back to kind of like, actually it was in the futures info. Here's that chart of contango. So imagine your USO. What you do as an ETF is to give you exposure to the front month oil, or the price of the front month where oil is trading as of the moment. So as of the moment, oil is trading here. So what's going to happen is in the future, they're going to need to buy this month. So we expired today. You can no longer trade that month, and you would have to go into the next month. And as you do that, you're going to have to sell this one at whatever the settlement was, which in this case was negative, and you're going to have to buy the next one, which is at $20. As you do that, what's going to happen is you're going to lose that difference if we go to zero again, and then you have to sell at zero again and buy at $20 the following month. So as you do that,
yeah. So, but don't they roll like 2 weeks before the expiry?
The way they do is they don't roll simultaneously. They roll a certain amount of their position over a 2-week period, a little bit every day.
Up until expiry?
I think up until almost the moment of expiration, a day or two before. So it depends on the ETF because there's a lot of them. I don't know the exact mechanism of USO, but what I do know is that as you roll over and go to the next month and the next month, that decay, as long as you're in that contango and you have a $20 or $30 difference between the months, is going to destroy that ETF.
Got it.
Does that make sense?
Yeah, but I'm buying it at 50 cents, right, or whatever it is. At that point, I'm expecting it to be destroyed.
You're saying you're buying the call on USO for what strike price?
For 50 cents.
Yeah, but you have to keep in mind, too, that if the price goes lower, they can reverse split the price, which would totally mess up the way the options are priced. That's what the leverage ETFs constantly do as they decay.
And then the option, you can't do anything with that option.
Well, they're just going to reprice it, and it's going to mess up the whole way it's calculated, and it's just going to be a nightmare.
Got it. Okay. Thanks.
Cool. Itai, you want to tell us what's happening with gold?
Yeah, let's switch up to the gold chart. So let's see where we're at. Okay, so gold is an interesting beast on its own. I've heard a lot of people saying, well, you know, should we buy gold, or how is gold trading, or how does it relate to all these things? And I want to talk a little bit about that and what gold actually means, and you know, why it's not the worst of ideas to have a little bit of gold in a diversified portfolio. So gold price has gone up significantly over the last few months. This is the gold prices measured in dollars, euros at all-time highs, pounds a little bit in the middle, and yens at all-time highs. So a lot of people think that the price of gold is just directly related to the dollar. There's all these you know, websites and things like that saying, hey, one of these days the dollar is going to get destroyed, and you know, the gold's going to explode. I'm not in that camp at all. I think gold trades in a very interesting way, and a lot of it has to do with all the other currencies in the world, or what we call fiat money, which is just a paper money. So these two charts represent the price of gold in all currencies but dollars. So if we take the aggregate of the currencies that are not dollars, you see gold has done incredibly well, actually much better than value than just dollars. And there's this belief that as the dollar goes down, gold goes up, and it's only partially true. Here's from the 1990s, the dollar index, which is the dollar measured against the currencies of all these countries, Argentina, Australia, Brazil, you know, et cetera, almost all the countries combined here in red versus the gold price in blue. So it is true in the 90s and so forth, we were going up in the dollar price and gold was very suppressed. Then after the dot-com bubble, when interest rates started going lower, and even more after the housing bubble, QE programs, et cetera, there was a big drop in the value of the dollar, which caused this move in the price of gold. But look what happened recently as of the last few years. We've seen this increase in the dollar price. Gold kind of stayed flat. And as of recent last few months, the dollar is almost shooting to new highs of this whole cycle. And and gold is almost at highs as well. So everybody's like, hey, what's going on? I thought that, you know, if the dollar goes up, gold should be going down. And there are a lot of explanations to the reason for that and what really drives the gold price. So I want to talk a little bit about why I think that's the case. So first of all, we have this issue where other currencies in the world are doing worse. And a lot of it has to do with this explanation of, you know, the US in a way is the dirtiest, cleanest shirt out there. So with all the problems that we have, problems around the world are more significant. Second thing, one of the reasons for the dollar move in the last few weeks during this crash was a $12 trillion margin call for risk assets. A lot of people borrowed money in dollars, and as those loans came due because of COVID, those had to be paid back in dollars, but that also you know, increased the price together. So gold is also related to commodities prices in general, but you can see, for example, right now, there's no demand for industrial commodities, as we see very well with oil. Nobody wants the industrial commodities, and gold has continued to go up. So what is gold correlated to more than anything? What gold is correlated to more than anything is the expansion in the US deficits. So we can see the blue chart shows the growth or decline in US deficits over time. Here is that small period of 99 to 2000 when the US actually had a surplus. And then the increase of the deficits and the gold price. So a 12-month rate of change in the deficit has been linked very well to the gold price over time.
So you're saying that gold is really a hedge against runaway federal deficits?
Right. So if the government spends way too much money and the federal borrowing just continues to increase, gold price should continue to go well if history is any judgment to that. And we can see that it's correlated with the general levels of debt as well. So the debt levels start to increase significantly here. So as the gold price, as the debt levels actually leveled off in recent few years, so has the gold price. So, and you can see that it's actually directly correlated much better to the federal level of debt than to the central bank balance sheet. A lot of people say, hey, the Fed is printing and all that stuff. That's going to increase the gold price. That's not necessarily true. QE3 between 2013 and 2014 was a mass increase in the Federal Reserve balance sheet, but gold actually had a big down move at that time because that money doesn't necessarily gets into the system in a way that is sufficient to increase the gold price. However, increases in the federal level of debt and federal deficits do. And that's the most important chart for gold. So if you believe that the US government deficits are going to increase over time, having some allocation to gold is a good way to benefit from that.
Got it. And Itai, could you share
I guess who do you think is going to win the election for that?
I'm sorry, can you repeat that?
Who do you think is going to win the election for thoughts of the deficit increasing or not?
Well, I think the deficits are going to increase regardless of politics, personally, because it will be very, very difficult to offset the impacts of coronavirus and maintaining the what we're used to without massive increase to the government deficits. We're already seeing some of that.
Cool. In terms of the economy and the economy opening up, there's just been a lot of talk about, is it going to be early May? Is it happening somewhere else? Doesn't seem like there's any real consensus. What are you seeing from the experts in terms of when the market's actually going to open again?
That's a good question. I don't think there is a necessary consensus for that, but I did pull up this chart from Morgan Stanley research that they try to kind of compile a bunch of information from multiple sources. And we are more or less right now on the top of the curve based on a lot of things that I see and a lot of kind of opinion and analytics. So if we are at the top of the curve, this is more or less how it looks like, where a realistic gradual open of the economy, maybe we see a little bit of it in May, a lot more in June, and probably a lot more into the late summer period of time. What's interesting is that a lot of the models shows this potential second wave happening around wintertime. But I think what they're saying here, this model, it could be a lot smaller if this event happens, which somewhere in October, they're saying this potential vaccine for healthcare workers makes its way to the system around this time. And then eventually, it becomes broadly available here. So I think this one is super interesting. Having the ability to test a lot in May may be able to open the economy in June. Ed, do you have any thoughts about this? I know you've done a lot of research on the topic.
This actually looks fairly good. A lot of our estimates are coming from the University of Washington, which is where Dr. Fauci is getting his estimates. You'll notice that.
Which is this chart. I'm going to open it right now.
Right. You want to go down to that, and it's spot on. I mean, the model says that we're going to have, this model says that we're going to have 39,000 deaths today. We have 41,000 as of today, or yesterday rather. So this is the most accurate model. And if it's a situation where we get aggressive testing in May, and we get, it's gonna follow lock and step with testing, because testing allows you to see where the virus is and what you can open up and what you can't open up, and it's going to be in phases. When you start going to restaurants, you're going to have to practice social distancing, so no one can sit 3.5 feet away from each other. Everyone's going to have to wear masks. And then as the infection rates go down and as we figure out where the virus is, and they're going to relax things. So it would be what would be good is to kind of look at where we are in the curve and then kind of look at where the rest of the world is, namely Asia, because Asia is where this thing is starting to die down, and kind of see what they're doing and then kind of line that up with where we are in the curve.
Where in Asia you want to see? I think China is not the best of examples, right? So it
No,
would be
China's data.
South Korea.
South Korea's not in there.
It's not in there. Yeah, it is. It is.
Yeah,
not.
it's not in there.
Okay.
China is, well, I think the information in China is a sampling of what their true numbers are, but it's not their true numbers. Yeah. And what they're doing there right now is that they're back to about they've lost a lot of economic capacity in March, but they're getting back in gear in April. So we're going to have to line it up with what they're doing, but I think the chances of us having a little bumpier path down is going to be a little greater, because we may not necessarily have the discipline. We certainly don't have the authoritarian government of China, and some of the discipline that some of these East Asian countries have. So it's our way to normality may take a little bit longer than Asia.
Right.
Cool.
But we could certainly, I would be happy to dive into it a little bit and provide a little more clarity next time.
Yeah, I would say that's a good idea. We can save that a little bit for later. I want to make sure we get time for Alan to speak. So we kind of mentioned that we had a guest speaker for today, and I'm going to want to turn that over to Alan. So Alan is the chairman of Belgravia Group. They're one of the largest developers in the city of Chicago. Alan's going to talk to us a little bit about why the current data really means nothing, and he's going to give us a little bit of a history of the cities versus suburbs and the potential kind of for the suburbs now. And it'll be a little bit of a history lesson. So Alan's learned a lot about the real estate world. I'm pretty sure he's on. I see his name on there. So Alan, would you like to introduce yourself, and would you like to talk a little bit into this topic? You are currently muted, so let's unmute you. All right, hold on 1 second. Unmute. Alan, you there? You're gonna probably have to unmute yourself. So if you got to go to that lower left-hand corner of your screen.
Got it. Can you hear me?
All right, you did it. Nice job. Hello.
Yeah, the old man did it.
Yes, he did. All right, Alan, you want to introduce yourself? You want to talk about this a little bit?
Yep, my name's Alan Lev. I'm from Chicago. I'm a friend of Jeremy for many years, and a friend of Equi for a lot shorter period of time. I'm a real estate developer in Chicago, multifamily, rental apartments, and condominium units, and been at it for 30 plus years, and never seen anything like what's going on today. Been through several recessions and downturns, but this is certainly unprecedented in my lifetime.
Got it. Yeah, I think this is something that we've never really seen before. And so, everybody's kind of curious about from the real estate world. What data should we be paying attention to? What are the indicators? How would you kind of help advise somebody that's looking for leading indicators and data around real estate right now?
I think the data is pretty much worthless right now because it changes every day, if not faster. And I don't think anybody really has a clear picture from a data perspective on what's going to happen. And that's not too dissimilar from what I'm used to in real estate anyway. Even if you are a data analyst, you're good at basically at what happened, not necessarily what's going to happen. And I think in real estate, you need to look more at psychological things like that as to where the world's going to be and where the opportunities are going to lie in real estate, and where the sectors are that are going to continue to suffer or suffer even more.
Got it. So we talked a little bit together earlier in the week about which asset classes are going to continue to suffer. You want to share briefly which ones you're feeling are going to be going through hardships and why?
Well, I think hospitality is going to continue to suffer, and I think probably for a long time. I don't know about the other people on the call, but at my age and my situation in life, I'd be really hard pressed to want to go stay in a hotel room, no matter how well they say that they cleaned it, for a long time. I think entertainment's going to suffer. I think we're going to be a long time before they're going to let 40,000 people sit in a stadium and watch a sporting event. Universities are going to be interesting. If they can open up in the fall, they have massive shortfalls already from this semester. But if they can open in the fall, I think they can recover pretty well. I think what we'll see happen, though, is because of the online learning that's been going on, I think you're going to see a change in many universities and offering more courses online and more curriculums partially online, if not fully online. University of Illinois, where Jeremy and I went, actually has a IMBA, and they were one of the first in the country, and it's exploded even before this. And I can imagine that the curriculums like that they can offer for a much lower price are going to gain more acceptance, and than they had in the past. Are going to be more prevalent and are going to succeed.
Yeah.
There's a couple areas.
Yeah. One other thing I'd interject is there's another company for years has been trying to push the CLEP system to start making more of these courses be able to CLEP out, because you can watch, algebra or calculus or biology from Harvard or Stanford now. A lot of these universities put these things online, and now there's a push. I think it's called Modern U. Been pushing for years to make more of the stuff CLEP'd out. And I think there's going to be, as people have been home, you're going to see more and more of that. So Modern U is one of the companies maybe to look at. I don't know if it's a nonprofit.
Yeah. Industrial might do pretty well, especially warehouse sector of industrial. I think we're going to, right now, or pre-COVID, I think online was about 15% of total retail sales. Is that about right, Itai?
Yeah,
that's about the number. It's not going to go up to 50% or anything crazy like that, but it's gonna go up. Some of the people that have been buying things online are going to continue to, because this has happened and is going to continue for long enough where it's going to be a new habit, and that's going to drive, I believe, the need for more warehouse space, especially in metropolitan areas where they need that last stop to be able to store goods and things before they're delivered on site. So I think you're going to see steady, if not increasing, warehouse development. Apartments aren't going anywhere. While we can do just about anything else online, we still need a roof over our head. So I think apartments are going to, I think May is going to be a real interesting month as far as rental collections are concerned. April was actually surprisingly good, but I think we're going to see a decrease in the rental collections next month.
Yeah.
But it'll come back.
Yeah, it will. I was going to say, in terms of, people are always going to need an apartment. They're always going to need a home. The trend of what's been happening is coming back to the cities. But we were kind of talking that, hey, the future might be in the suburbs. Could you start by telling everybody a little history of just the city versus the suburbs and how this pendulum has kind of like moved back and forth and where you think it's going?
Yeah, I mean, I'm not old enough. I was born in 1960, but I know enough history, at least in the Chicago area, and I think it's similar in the other big metropolitan areas in the country. But there was a big migration in the 1950s and 60s out to the suburbs, and the reason is the interstate highways were built, starting with the Eisenhower administration and the rail lines, the commuter rail lines, and it made it easier for people to leave the city and go out to the suburbs where they could get more living space for less money. And they were able to commute on some reasonable basis downtown, wherever city it would be, for their job, which is what people did. But then what happened, and prior to that time, all the cities had great housing stock. I mean, you see the bones of all these cities, including Chicago. All the neighborhoods had just beautiful residential developments and homes. And then what happened was the flight into the suburbs, and then people gravitated to living in the core of the cities, if at all, and then the peripheries of the cities just died. And but what's happened now in the last 10 years, call it, you've seen a flight back to the city where young people and baby boomers have wanted to move back because that's where the action is. But the prices are much higher in the city than in the suburbs, and you get less space for it. So you're paying a lot more for that convenience of being in the city. And I hypothesize that with what's going on now, and people in all types of jobs being able to work from home or work remote or not have to work 5 days a week downtown, is there going to be some resurgence of maybe not necessarily the outer suburbs, but parts of the city that people didn't want to live in before because it was a little too far. It wasn't in the core of the city, or in the close in suburbs like in Evanston here, which is close to Chicago, where people can get more space. I'm talking to a lot of people who are cooped up in a studio or one-bedroom apartment and aren't too happy right now with their living situation, but that's what they could afford to be in the core of the city. And I could see where that might change, and people will opt to take more space that is less expensive than being in the core of the city. And if people are going to be able to not have to travel as much, and they're going to be able to work from home some, the commuting part of it probably won't be as important. So take Austin, Texas, for example. It's pretty expensive to live where Jeremy lives. But, the areas that are 30, 40 minutes outside of Austin may become more popular than they've been.
And they've already been fairly popular because we've seen the beginning of that trend.
Yeah. So I can see that. Retail, I think, to quote a good friend of mine who's from South Africa, retail is fucked.
Yes,
So
it is.
And I don't see retail all of a sudden rebounding. We had a retail problem before COVID. In most parts of the country, we're over retail, period. And you already saw a move when space was empty to not being able to fill it up with true retail space, but instead having a daycare center or a Pilates studio or something that wasn't really a true retailer. That's going to get exacerbated with what's going on now. And we're not going to be able to fill up all the retail space that's out there, and all these retailers that are going to go out of business. So
knowing that there's going to be this glut of extra space, like where is the opportunity for somebody who says, I believe retail is going to be dead, but there's going to be something else that comes up? What could that something else be?
Well, it started already. Even before what's going on now, you have seen shopping centers, and mostly in the suburbs, not in the urban areas, where they've torn down a big box user because the big box went out of business. They couldn't replace them, and they tore it down and built a small mid-rise apartment building. So now they've basically created a mixed-use project that wasn't a mixed-use project. So maybe they took 25 or a third of the retail out of service and put residents in there. I think we're going to see a lot more of that. I think what will happen is we won't see the pain and the defaults on the retail for probably 6 to 12 months. People are going to try and hang on, but many of them or some of them won't be able to hang on at the point where they have vacancy and it lasts long enough and they can't fill it up for the kind of numbers they've been getting. So it's going to take a while for retail in certain places to fail. And only when it fails and the bank takes it back or they're really aggressive in trying to sell it, is it going to move. And when it moves, people are going to buy it at a price where they can change the use of part of it or all of it. And it makes sense for something other than pure retail.
Lev, do you see that possibly like in malls and these big box retailers that are going out of business you're talking about, those would end up being like used storage units? Because they seem to be perfect for that. They come in and build some more structure in there to make them just storage units.
Could be. It's a very passive use. So if you still have retail there, it's a pretty bad use to be there. I think there's going to be a need for more storage space, and storage space historically has been pretty recession proof. People put their stuff in there and they forget about it and they keep saying they're going to take it out and they never do, and they just keep paying. So there's going to be need for some more storage, I think. If I were owning some big regional mall or something, there's one out here by us in Northbrook where they tore Macy's down, and they're putting apartments in there. I think you'd be hard pressed to want to put a storage in there because again, it really doesn't help any of the other retail.
Yeah, I know from somebody that I worked with, or that he worked with he was the accountant for a storage, investment company, and he said their break even was like 50%. Once they're 50% occupied, they're making money above that.
Yeah, there's some really easy metrics to find on the storage. I have a good friend who's in the business. He's one of the top brokers around this area, and he could tell you that too much storage in this little area, a need over here, and he can really pinpoint it very well. Another interesting, again, I don't have the crystal ball, but senior living. The baby boomers like myself, we're all getting older. We're all going to have to do something. And there was certainly a shortage, or at least a perceived shortage, of senior living opportunities pre-COVID. But now you're seeing all these deaths in nursing homes and in other places, and it just spreads like wildfire. And I don't know whether that means that people are going to try and stay in their home absolutely positively as long as they can and not want to be in a situation like that where they're exposed, and unless they absolutely have to. I mean, I think there's been a lot of people, including my mother-in-law, who didn't have to be in a place but decided to be in a place for the social aspect and ease. But maybe people won't do that as much, and maybe they'll hang on and live in their places longer.
Alan, that literally leads me to a question I wanted to ask you about it. So I know one of the reasons, and I wanted to cover demographics much more in depth next week, and we will do that. But one of the reasons the suburbs rose in the beginning in the 50s and 60s was because baby boomers are the largest living generation. And all these basically their parents were having kids in the 50s and they needed more space. So that's one of the reasons they moved to the suburbs, right? So what we're seeing right now with COVID, and I've heard this before, is that we're all talking about that silver tsunami where all the boomers that own all that suburbia real estate are going to eventually start selling it because they're going to downsize or move to these retirement homes. So do you see this as potentially delaying that silver tsunami? And what is your take then about the pricing of the suburbs if, all these baby boomers are going to stay in for another 5 to 6 years?
Yeah, I mean, the suburbs have been, certainly around here, have been dying in the last several years. The combination of younger people wanting to live in the cities and not wanting to move out to the suburbs, later household formation, getting married later, jobs, student debt, a whole number of things. And then in many metropolitan areas, the big companies woke up and said, oh, geez, all our workers are in the city, all the young people, so they've moved their headquarters, whether it's Walgreens or McDonald's or Motorola. I mean, every metropolitan area has that story. So what had happened pre-COVID is if you had a house in the suburbs, even really nice ones, it was tough to move your house, and you likely couldn't even get your money out, or unless you owned it for ages and ages. That might change.
Would that be also, though, you're in Chicago area and you're in Illinois, and there's just a lot of problems in Illinois that's not as exacerbated in other states?
I think it's worse here, but I think it's the same thing where people, there was a move to go back into the cities, but it's more expensive. It's more exciting. It's more fun. There's nightlife. There's other things going on, but it clearly was more expensive, and you could not buy the same size place in the core of any of these cities that you could in the suburbs. So I think it's a similar thing. Illinois has got its own unique fiscal issues that are making everything even harder. Now that's why Illinois and Chicago have net population growth of negative, whereas other places don't. But there has been a move for years now to go back into the cities, and maybe that's going to change somewhat. Maybe because of COVID and being able to work from home and to be able to not. While my daughter lives in the city, she doesn't really go out on walks because you can't go anywhere without people all over you. And so there might be some change. Another change I see is co-living, which is started to kick off in some areas where, you live with a bunch of strangers. I have a hard time seeing that being a good business model for a while, for a long time.
Right.
That's something that the younger demographic tends to lean toward.
Yeah, but also these micro units. We got some micro units in Chicago and other places, and frankly, you're doing some micro units in your Austin area. If I'm going to have to spend more time voluntarily or involuntarily in my place, if I can afford it, I want more space. Well, you probably can't afford it. The reason you're in the micro unit in the core of the city is because that's what you could afford. But maybe now you're willing to move, somewhere in half an hour, 45 minutes away to get twice the space for the same cost.
Yeah. And Alan, I'm gonna transition the conversation there. So, a lot of this, a lot of what we've been talking about is, future of real estate trends, and we kind of talked that everybody agrees that, hey, work can be done remotely. A lot of the people on this call are doing it remotely. It means that people are going to be able to work from home more. That means that there's office space that could really get crushed. So, Itai, if people have this thesis that office space can get crushed, how can they potentially trade on that thesis and make a trade for themselves?
Right. So I'm just going to demonstrate a type of trade that can be made. I'm, again, not saying anybody should make that trade, or not saying I'm making that trade, but for the sake of thinking about a trade that can happen to benefit from it. Again, the way I like to do things, I don't like to have a lot of upside risk if I want to be short something. I want to give myself enough time to be right, and I want to do it in the best possible ways. So I'm going to show you how hedge funds do this, how they look at things in this risk reward kind of way, and let's dive into it. So I'm gonna share my screen here again so we can see what we're talking about. And it was on this one. So I looked here. I looked for companies that are liquid enough and have enough office space that we can take advantage of. So I don't know how many people are familiar here with Edgar SEC filing. You can actually look for all the information that you want about public companies. So I found this company. It's called Boston Properties. Their ticker is BXP. They're actually quite large. And what they do, let's see where it is exactly in companies business. Okay, right there. And they are in the business of owning office space. And that business is concentrated in 5 markets: Boston, Los Angeles, New York, San Francisco, and Washington, D.C. They have 196 commercial real estate properties, all A-class office buildings, and they're all very expensive in very expensive metro areas. So to me, that sounds perfect. An ideal candidate for the thesis that we're kind of trying to cover. So
I would short it.
Sure. So how would you go about shorting it? And here is now that we've selected our target, let's look at it. So here is this company, BXP. So we can see there's already been a significant drop. The stock went from $147 to $80, rebounded a little bit, and now it's back down over 4% today alone. And it's trading at $91. Going a little bit further out, we can see that in 0809 it was as low as $30, and we could potentially say, well, you know what, it could go very well back to where it was in 0809, because the conditions for office space could be very similar. So what we have to keep in mind is that this company pays about a 4.1% dividend as a REIT. So if you're just short this company, you have to pay that 4.1% a year, and you're exposed to upside risk. So if this COVID situation, I'm not saying that it will, but this COVID situation becomes better, people go back to offices, our thesis is totally wrong, the stock goes way back up, we don't want to be liable for that. We don't want to necessarily suffer from all that happening. So what do we do? How do we cover ourselves? Well, I'm going to tell you something you probably haven't heard before. We're going to buy the stock in order to short it. So what we're going to do is we're going to go along the stock, we're going to buy it, and today it's trading at $91. and we can go into the Analyze tab to see how that would look like. We buy the stock, and then we go out and we sell the call. So we buy, let's say in this example, 250 shares of the stock. Okay. It's actually supposed to be 2,500 shares of the stock. We sell calls against the stock to cover the cost of buying it. So it's a covered call, but then we go out and we buy 2 times the amount of puts further out of the money. So as you can see, the cost of the calls and the cost of the puts, there's a little bit of a bid and ask spread here, but they should more or less be even, giving us the ability that if the stock falls below our strike price or towards our strike price, we start having exponential gains. If the stock gets to our strike price, it just gets called away here, and then therefore you won't have a loss. This is actually not necessarily true.
So you're basically saying the upside risk is almost nothing, because somebody's going to say exercise their call option, take the stock, and this is really a play solely on the downside if it really crashes.
Yeah, so in this example, if we bought it at $91 and it goes over $95, the stock gets called away and you're fine. But if the stock really crashes and starts plunging through that $70, you are long 2 puts for every stock that you own. So you're making money as if you're short the stock. If the stock just hovers around and plays around here, you just get to collect that dividend.
Itay, wouldn't it be easier just to buy the 95 put, one 95 put, and sell a pair of the 70 puts when you have a synthetic and one less transaction, and do the same?
You could, but and it will cost you a little bit less collateral. I like to buy it for the reason that I want to get paid that 4.1% dividend.
Okay.
So you're saying that the actual REIT pays out your 4.1%. So you just holding the underlying, you're going to make your 4% on that, assuming they pay.
That's assuming they still pay, and if they're
right,
because that's something that's going on now too, right?
But if they don't. But if they don't,
a REIT's got to pay a certain percentage of their
90%.
Yeah, but if their people aren't paying tenants and stuff, they may cut off the dividend.
That's right. But if they do that, the stock is most likely going to crash, and then it will be a jackpot trade, because that's when the puts go in the money and we start getting that exponential growth part. So,
and then in that situation, you have 2 puts, so you're actually getting double the return.
That's exactly right.
Got it. So this is like, so the hedge fund managers, when you hear that they made, $1 billion on a trade, like a Bill Ackman, this is kind of what they do, right?
Yeah, they do some kind of ratio in which they are long more options than they're short. The short that they do kind of covers a lot of the cost, or sometimes all of the cost. So it's all about a matter of kind of how you structure that trade. So in this case, you're actually shorting it, but you're going long the stock. You sell a call above it, so you get the cost of the put. Then you're long 2 puts. If this thing really tanks, you're long 2 for every stock that you're long. So you start getting into that exponential growth part. Nothing happens. The stock just goes around between the strike price. I still get to collect that 4.1% dividend.
Got it. And so in this situation, the puts that you're selling, can you remind me how far out they are till expiry?
So the longest expiries I saw listed were to October. So I just do it till October as long as I'm allowed to. But because it's costless with the calls, if nothing happens until then, you can continue to rinse and repeat and just roll it over to the next 6 or 8 months, whatever it is that you can do it for.
Got it. So let's say if Chris was in here, Chris owned a whole bunch of commercial real estate, and he was talking about how he says that this is worse than 08, 09. If we say that the price could potentially go to those levels, what might somebody stand to make if they perform that trade?
It depends on the size you're doing, right? But in something like the size that I put in, which is not extremely big, just to show in the Analyze tab, a ratio of short 25 contracts and long 50 contracts. If it goes to where it was in 08, 09, which is $30, you'd be at about $184,000 gain on a 25 by 50 ratio.
Got it. Cool. All right. Well, Itai, thank you for sharing that. I know for everybody
Sure.
that might have been a lot. We record every single call, and we always send it out at the end, so you'll be able to know exactly where we start talking about this. Obviously, it's up to you to decide whatever you want to do. But let's. We covered a whole bunch of different topics. I kind of want to open this up for everybody to do a little bit of Q&A.
Somebody had the question I was going to ask on that last trade that you were talking about. How much did you have to risk to make the $184,000?
So it depends where the stock closes. So if the stock closes exactly at 70 at expiration, it wouldn't necessarily be that way because you'd be able to sell some of those puts. But I would call it would be about a 25 grand risk to 30 grand risk at most. But keep in mind, you're also getting paid that dividend, which is 4.1%. So if it just wobbles around in that period of time over a year, it's probably going to be negligible, like 10, 15,000.
Hey, Alan, I had a question about, you had alluded to some of these retail centers having a lot of these vacancies and starting to open up more, and maybe some of them turning into multifamily residential. So how would that multifamily developer optimize their way into that? Would they then lease like the big box retailer would, or would they try to buy a portion of that parcel from the underlying owner? Or, I mean, I don't even know if this is something that's really been done.
It could be, or it could be that you wait until somebody fails on their retail center and you're buying it at a distressed sale, either in a foreclosure or a deed in lieu of foreclosure. It might well be that the equities that the owner has is just not there anymore, and you need to wait until there's blood in the streets here to be able to get it at a basis that it works. But what you were getting for rent, 5 years ago is probably not what the retail rent is today. If somebody's viable and they're big enough, and maybe it's owned by a public company, then they probably do have the wherewithal to either redevelop a portion themselves or to sell off a portion of it to somebody else if they don't have the expertise in the multifamily. You could do a ground lease. I mean, there's, you could buy it outright. It's a lot of different structures. Really all comes down to cost and what basis you can get in to make it work for the density you're going to get for the residential, because it's probably worth less as residential land than it is as high-end retail land.
Right, and then because of the being retail zoned versus residential zoned or multifamily zoned, there's probably going to be restrictions on how high you can build it, right? So it's going to minimize the density capacity and how much dollar per foot you can actually rent out, because you can't have, maybe you can only have 50 units as opposed to 100 units.
Right, highly likely that you'd have to get some change in the zoning. Although I will tell you that based upon what's going on in the world, vacant retail doesn't generate much in the way of real estate taxes or sales tax for the municipalities. So they seem to be a lot more open these days to exchanging fallow retail for apartments that are going to pay real estate taxes. So they seem to be more open to it.
Hala, I have a question for you. When you were speaking earlier, and once again, I do appreciate the insight that you provide with all your experience. At a very high level, what I understood is you view COVID and everything we're going through with COVID as a fundamental marker of a shift of mentality when it comes to how people view real estate. Like you don't believe this is just a shock, a short-term shock, and there's a reversion back to how life used to be 6 to 9 months ago.
Not for a long time. I got to tell you that we're still seeing 12 years later some of the aftermath of the recession of 2008, where people have changed habits and have done things differently from then. So I think that the public remembers for a long time when they lost a job, or their parents lost a job, or they lost savings, or the value of what they bought isn't what it's worth anymore. People I know that sociologists, et cetera, will tell you that people are far more upset if they don't want to lose money. And if you gave them a rational choice between, losing X and gaining Y, they would shy away from the losing the X. So I think it's, even if we're past this in some way, shape, or form in a year, 2 years, I think there's going to be an overhang of habits and what people will do for a long time after.
Alex, it's Ed here. How was this compared to 81? That was a severe recession in 81. I don't remember that, but interest rates went up to like 14%.
Yeah. I wasn't in business at the time. I thought it was great that I was getting, double digits on my money market account at that time, not realizing that high interest rates like that really were a burden. People managed. People bought homes still. The values weren't as high because obviously with the interest rates being higher, it impacts value, but people were still figuring out how to do things. My business partner was in business at the time, and they were very creative and figured out ways to get mortgages for people. And while that wasn't good, it's a far cry from what's going on now.
Okay.
That makes sense. I would say, everybody, let's get maybe just one last call. I know this has gone a little bit longer and people are kind of hitting the hour mark. So if there's one last call with one last question, I'd love to have you throw it out there. And then I'm just going to give you the little quick wrap up and what to expect for next week.
Is it cool to jump in?
Yeah, go for it.
Okay.
Good to see you.
Yeah,
I love the background.
Hey,
The
he's a
Bears.
super fan. The Bears.
The Bears.
Alan, by the way, Chris Deutsch, my father's Owen, and he's an investor.
Oh, yeah, sure. I know
We've
your
met a
dad.
couple times at Lincoln Park Builders.
Yeah.
I guess this is more of just a comment and observation, looking at from like the tech side, because I live between tech and real estate with my father's business at Loft. I started in e-commerce back in '98. We started one of the first e-commerce platforms. We targeted, we powered very large online retailers like Target and Overstock and MTV. And we were envisioning 20 years ago, more than 20 years ago, the push to e-commerce versus retail. Why? Because it's obvious, it's easier. There's no comparison between the ease of going online, ordering something, and it coming, to your front door than having to go out and shop and like all the rigmarole. And we were expecting it to happen a lot sooner. What enables, so technology is always going to make our lives a lot easier. It's not necessarily better or richer, but it's going to make our lives easier. And so what are these things that spur that adoption? It's major shifts like we're experiencing right now, right? And so that's an analog to real estate in terms of, especially in commercial, in our flavor. So we had a family business in commercial office buildings. We sold 3.5 years ago, Loft Development Corporation. And thank God, because what we're experiencing right now, this behavioral shift, is all around ease and convenience based on we have to stay home now. And we're realizing, well, it's actually not that much more complicated for me as the employee or as me as the manager or owner of a business to say, well, look at what we're doing right now. We're all on a Zoom call, right? Like we're basically in our pajamas and whatever. We don't have to spend all the time and energy to get ready in the morning, to drive to the office, to take our paid dog walkers to walk our dogs during the day. We can do most of that stuff ourselves and still be more productive from working at home. So when you think about that's why I said it's so much different from 08, 09 in terms of commercial real estate. That was just a bad economy. Like we fell off a cliff. I mean, it was a lot more in a bad economy, but it wasn't something that was necessarily a fundamental shift in behavior. We were trying to go to offices. We were trying to manage people in physical spaces. Now we're saying, why is that needed? There's no real need to do that anymore. You're going to see companies that had 10,000 square feet or 100,000 square feet go down to 3,000 square feet or 30,000 square feet. And that's
Right.
going to be pretty common because they get to save money and they're going to have the ability to give more flexibility to their employees.
Right.
So
Maybe they're not. Maybe the open office concept is a thing of the past too. where all the, everyone was just in a cubicle or something. This thing's not going away in 6 months. This is going to linger for a while. And those companies that do have people come in, they're probably going to rotate the people coming in. They're going to separate them from other people. This is going to linger for a long time, and it's going to change behavior, like you said.
Right, but that's also sort of like that's like the midterm, or like before we get through this COVID cycle, right? Because we still have like the next year to year and a half, we still have this physical distancing issues and such, which, by the way, like just as a side note, I don't know how restaurants are going to open up at half. They can't make money at that, right? So they say, okay, well, we can open up, but you can only have a third of your patrons there. No restaurant's going to do that. I mean,
the restaurants that are holding in there right now are the ones that are doing heavy delivery and pickup service. The ones that have adapted to do that, and the ones that I know have done that are actually hanging in there okay.
Right.
But it's your fine dining kind of place. Boy, I don't know when that's coming back.
Agreed. And so I think over the sort of like midterm, like let's say 3 years out when leases start to come open. I don't know, Lev, if you ever saw Alan, if you saw the space over at CBRE and what they did with their hoteling maybe 4 or 5 years ago, where they, CBRE is about the future and they're trying to coach their tenants that they rep on this, or even offices. This is what the future is going to be. Nobody has their own set office. Everybody sits down at a workstation and plugs in for the day and they leave. Well, the purpose of that is you can reduce your footprint as a tenant by 20, 30, 50%. Well, that's now going to be a reality, because as leases start to come up and people start to renegotiate either new leases on a reduction of space or completely move to a new building, they're going to be saying, well, why don't we just have a bunch of workstations where people can come in 1 to 3 days a week and they don't work at any one desk. They don't have their own office anymore. They just come in and what we call hoteling. So anyway, that's why I said, Jeremy, I think this is really a fundamental shift in terms of how we think about work and workspaces. And there are going to be very few companies that really have, I mean, obviously companies where you have to be there manufacturing, or even in some cases manufacturing, obviously more automation, but it's going to radically shift the office business. And that's why Owen and my father and I were just talking about this 2 days ago.
I remember when I was trying to get office space, and I actually saw that CBRE space. And so that was years ago. And I do think it's coming to fruition. So in terms of, mind shift, I think that's kind of where real estate's going. I just want to wrap this up. For everybody who came on, thank you. Next week, please pay attention. It's going to be absolutely freaking insane. So we'll make this public for the first time. We're actually going to have one of the largest money managers in the world be our guest speaker. It's going to be crazy. You can't get an audience with this type of person, if you wanted to. So he's going to come on and he's going to share a little bit about how to think about markets from a totally different perspective that you never did. And we're also going to talk very, very heavily into a topic about demographics and how it really impacts the entire world around you in a way that you never expected. So I think if you ever wanted to tune into one of these little sessions that'll change how you look at investing permanently, this is going to be it. So I really want all of you to share with the other people that you care about, because it is going to cover a lot of very, very key topics. So I want to say thank you again to all of you for coming on. Thank you to Mr. Alan Lev. We appreciate it so much. We will be sending out a summary of all of this. We'll let you know exactly where in the meeting we talked about everything. And, we're always open to feedback. So thank you all so much. I'll hang on for the next few minutes.